Welcome, I'm Catherine Magana here with Steve Wolf, Rachel Ivanovich, and Vid Stefano, where we're here to provide you some insights about the markets, planning. So here we are, it's September 5th, we're past Labor Day, and we've had a pretty interesting first few days in September. It's been a little volatile these last few days. And as I look back over the last week, it looks like some of the tech stocks and S&P 500 is down. The Dow stocks haven't moved too much. They're moving a little bit today, but it's interesting to see that the Dow stocks haven't moved as much as some of the other indices over the last week. Also, we're hearing interest rates obviously have been a big topic that we've talked about. It looks like the odds of a 50 basis point rate cut rose to 45%. So we'll see, is it 25 bips or 50 basis points? But we're definitely going to see something, and we'll see. But that's kind of what we're forecasting.
Well, the economy is definitely slowing down. I was been reading about Treasury yields. They tumbled a little bit, and because the U.S. manufacturing market is shrinking, which it really has been for the last 2 years, but we're seeing more of it right now. So the economy is slowing down. I think that whatever the Fed is going to do, whether it's a quarter or a half, and I still don't think it's going to be a half, but we'll see. I think that's already in the market. That's already in the market because that's what people are expecting. If it's anything other than that, then I think the market will react to it.
And then it looks like ADP came out today and said that the jobs showed 99,000 jobs instead of 145,000 jobs, which is obviously a big change. But the report also said that the annual pay was up 4.8% this in August. So that was, as we're looking at inflation and as things are costing more, that the pay is increasing, which was kind of interesting.
I think the pay is kind of a lagging indicator because people have already done that and it's now showing up.
Yeah.
But I think going forward, I'm not sure you're going to see that, let's say 4 or 5 months from now.
I'm going to chime in a little bit and talk about where the market was through the end of August and now what we're seeing in September and what happens sometimes during the month of September and the first couple of weeks of October. There was a great article in the Wall Street Journal on September 3rd, yeah, and they talked about how U.S. investors actually piled into stocks during the summer period, and the indices went to new highs. In fact, 81% of the S&P 500 stocks hit new highs during that time period. According to Fidelity, number of 401ks that are greater than $1 million was up 31% to 497,000. So a lot of newly created millionaires are out there. And U.S. household allocation to stocks went to its almost all-time high of 42% of their total financial allocation. So, even during very volatile periods, people were stepping into the market and buying stocks. Now, we walk into September, and we're starting to see what happens when the ghosts of September start. Historically, September is probably one of the worst months for the market, and on average, it's down approximately 4%. We're coming off a strong summer rally, so you're going to see some profit taking. Also, the majority of mutual funds in the country, their calendar year ends September 30th, so they start doing their capital gains and start all of that. So that could have put some pressure on some stocks because they start selling earlier and earlier every year. And you also we're seeing the uncertainty. As we just mentioned earlier, interest rates, what's going to happen with interest rates? Continued uncertainty with the upcoming presidential election. What is going to be the continued turmoil in Ukraine and the Middle East, and probably more important, what's going to happen to the consumer? Because as Steve just mentioned about a slowdown, there's a real worry about global growth slowdown. And Catherine, you mentioned tech stocks. Well, if you remember in Catcher in the Rye, Holden Caulfield always wondered where the ducks went in the winter when the lakes in New York froze over. Well, I'll tell you where the ducks went. They went into tech stocks.
You continue to amaze me with your literary expertise.
And here's the other thing that's kind of interesting. You still have $6.2 trillion in money market funds. So as you just mentioned, if the Fed lowers rates, and they do lower rates more than anticipated, where does that money go? That's a big question. Do they stay in money market funds and just suck up the lower rates? Do they move to T-bills because maybe they're going to get a higher return, or do they move back to stocks? So, I always tell investors, don't force the issue in September because it's an incredibly volatile month. If you've got a really strong stock portfolio and the fundamentals aren't being eroded, hang tight.
What's interesting that you talked about interest rates and the Fed, and I was looking at some short-term yields recently on CDs and Treasuries, and they've shifted. I think they've already priced a lot of this in, and so we're not seeing those over 5% yields that we were seeing. So you're right. I mean, what are we going to do with some of that cash? And I think for a while we had those decent yields, but we've talked about in the past it's not going to last forever. And what's the best place for you to put some of your money? Even the short-term or even the 1 to 10-year yields have changed too. So,
speaking of yields, we talk about mortgage rates, and I think mortgage rates have started to come down. But it's interesting; it's kind of a conundrum because there's a lot of pent-up demand, if you will, for people who want to sell their house, but they've kind of waited because they felt that they'd get a better price. But along with that's going to come a lot more supply on the market. So, but right now, I was just hearing on the radio, I think a couple of days ago, that people are starting to say, I'm not paying this much. Mm-hmm. So we may have seen the top of at least residential real estate. And even though that rates are coming down, I think that people are saying, I'm just not going to pay that much. Now, if rates come down enough, if rates come down enough, yeah, that will spur more demand. But the real estate market's going to be interesting. People are still talking about a recession. My goodness, we've been talking about this for 2 years now. Mm-hmm. And maybe now is finally the time that it happens. I don't know. Okay. But interestingly, I think the real estate market, especially the residential real estate market, is probably topped out for now. We'll see.
So as we're kind of went over the markets, sometimes I'm always looking for some planning tips and ideas as we deal with a lot of clients that are phasing into retirement or thinking about retirement. And so I have 4 steps to retirement planning success that I found through Think Advisor. And step 1 was creating sustainable income. So as we do financial planning, we look at your investment strategies, we look at your annuities, your pensions, your Social Security, and what's the best way to maximize your Social Security. It's not a one-size-fits-all. I mean, it's very individualized and depending on health and in your income needs. The second step is protection, which is your life insurance, your long-term care, your health insurance, and making sure that you have the right coverage. Obviously, if you're on Medicare and there's different plans and things change, that's why it's important to reach out to your Medicare specialist. And then from a long-term care perspective, that's usually a financial blind spot we see in financial plans. Step 3 is tax planning, which is right up Rachel's alley.
Absolutely.
So here
it's that time of year.
Exactly. And we have these conversations all the time. We're looking at, how can we reduce RMDs? We look at charitable distributions, qualified charitable distributions. We talk about Roth conversions, estate planning, and how your investments are allocated. So there's definitely some tax planning in retirement planning. And then step 4 is legacy and gifting. So there's trust, there's life insurance, there's charitable giving. And so how does that all tie in together? So as we do financial plans, these are all the types of things that we cover. Yes, we have a very strong investment background and view, but really a lot of it is planning and then making sure the investments tie into your financial plan.
And it really is a planning time of year in the tax world. September brings third quarter estimates, which are due. So if you're making money and you don't have withholding, you want to make a payment. It's due on September 16th this year.
What if we don't want to make a payment?
Oh, man.
You can take that up with your representatives.
Okay.
Yeah, penalties, exactly. And that's something that people don't really think about when they do tax planning is you can plan to avoid penalties because a lot of people they don't think about it and they pay their taxes in April, but it is a pay-as-you-go system, so you do want to be paying quarterly if you don't have withholding on your investment income or self-employment income or whatever other income that doesn't have withholding. Another thing about planning that I think is really important, the IRS is proactively looking to protect taxpayers. And so previously, you couldn't get an identity protection PIN, it's a 6-digit number, unless your identity was compromised. And now they actually have an opt-in program for taxpayers. So this would be really important for next tax season that you apply for this number right now. So everyone is now eligible to voluntarily get an IP PIN or identity protection PIN that will help protect you from identity-related theft. And so how you do that is you can go online. It is a voluntary program. You must pass a rigorous identity verification process, so there are multiple steps to that. And spouses and your dependents are also eligible for this IP PIN if they can verify their identities as well. So the fastest and easiest way to get this is to go online. You go to irs.gov/IPPIN, and a tool will pop up. You can fill it out, and by next filing season, you should have that PIN. It basically gives you a second layer of protection when you're e-filing your return.
Say more passwords.
More passwords, yes.
But it's good to be secure and protect, and obviously
we've seen an uptick in returns that get rejected. If your identity has been stolen, your social security number, or let's just say somebody's already filed with your social for the year, your return will reject, meaning it doesn't get e-filed, and you have to print it out and paper file it. And then, of course, you have that issue where someone else is using. So this is a way to protect yourself against that.
Okay, well, we did see, going back to the stock market for just a minute, we did see a lower market, what was it, on Friday or Monday?
Well, Tuesday when we got
Monday,
back. When we
yeah.
walked back.
Tuesday of this week was a bad day.
It was a bad day.
And people were saying that the chip stocks were way overvalued, the AI stocks, et cetera. From our viewpoint, the chip and AI stocks, they still have a long way to go, our opinion. It doesn't mean that there's not going to be profit taking along the way. And every company that goes up a lot over time, there's always times when it pulls back. We think this is one of those times. I know some of the biggest companies around have said they are spending a tremendous amount of money on AI-related issues. So it would be hard for me to believe that over the course of time, I'm not saying the next 3 months, but the next 3 or 4 or 5 years, that a lot of these stocks don't continue on their upward pace. Now, they won't go at the same pace that they did. They can't. They're too big. But just be careful about being too emotional. I guess that's where this comes down to. People, when they get really scared, they say, hey, now's the time that I got to get out because I'm going to lose all my money. And that rarely, if ever, happens. I'm not saying if ever. I guess it does happen occasionally if you're in horrible companies. But I did look at the CNN fear and greed. We're in the neutral territory right now, up a little bit from the fear that we seem to have had about a month ago. It wouldn't surprise me if we move back down into fear because the economy is slowing down. But don't make any rash decisions based on your emotions. We know that. We say that a lot here. It's one thing to say it. It's another thing to do it. It's another reason to have a good financial person in your corner who's going to keep you from jumping out of the window when you shouldn't be doing that. So if there's nothing else that we've got this week, we'll see you again next week. And thanks a lot for listening.
Thank you.
Thank you.
Thank you.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.